This past month, I've had one of the best trading months of my entire career. And I did this only trading a few days per week, taking between 3 to 6 trades per day. In this video, I'm gonna share with you this simple step-by-step scalping framework that I used to be able to get these consistent results. And this strategy isn't one that requires hours of pre-market research or trying to guess where the market's going to go ahead of time. Instead, all I have to do is enter a trade when it aligns with my simple 3-step checklist that I'm gonna share with you right now, set up my positions to let winners run and keep losses small, and you'll see by following this with risk management and consistency, as well as a bunch of live examples that I'm going to show you of me doing this in real time, how consistent and repeatable this process is to be able to get great results. Okay, so the goal is to learn this framework, see examples of it working with proof, and hopefully be able to apply some of it to your own trading. Okay, so our goal today is to be consistent using one simple proven strategy. And understanding this framework is going to cut out 90% of the nonsense for you and allow you to see clearly, and this is what I've been leaning into to be able to have one of my best trading months in my entire career, getting really consistent results over time, just following this framework, not doing anything crazy, not having to be right every single time, but just following a proper framework. Okay, so what is this strategy and how does it work? Now, I've been able to boil this down to 2 major things, and then each of those subcategories has sort of some things to understand. I'm going to walk you through exactly how to understand this. First thing in the A category is marking off what are called opportunity zones. All right, this is going to keep you in generally a good place in the market. This is going to show you areas of opportunity in the market where something new is happening that's going to allow you to get in early and play into big moves. So I'm going to show you how to mark off those opportunity zones. That's going to be the first step. Okay, and then category B over here, this strategy works best from 8 a.m. onward, and all we have to do is follow 3 sets of major criteria. Okay, I'm going to go over some confluences, some added stuff, but it really boils down to 3 main criteria. So adding criteria plus these opportunity zones to get us in a good general area, follow our checklist to eliminate and further filter, and then be able to set up our positions from there. All right, so let's get right into it. Talk about step 1, which is identifying these opportunity zones. Now, the strategy we're talking about, I primarily use on a 1-minute time frame, but this is applicable between 1 and 5 minutes. We've seen a lot of results on our team between these time frames. So what we're really looking at with these opportunity zones is basically tracking the flow of markets to be able to pick up the current trend that we're in, and then the exact moment where we're actually breaking out of that trend, which is potentially leading to the beginning of a new trend. All right, and that's going to start to look something like this on our chart if we go over to a candlestick chart. Okay, so this is a downtrend. We get a push up. This green area is an uptrend, downtrend, uptrend, and downtrend. All right, so let's look quickly on a charting example. So I'm going to switch over just to lines so that we can sort of more conceptually understand this, and then we're going to look at some of the nuances with the candles. So you can see what we're trying to do here is identify trends and then where the breaks happen. So we can look at a trend and fully identify it by having a push to the downside, producing a lower low, a push up, a lower high, a new lower low, and a new lower high. Once this level is broken fully again, that's confirming the direction of a downtrend. And the same thing is true for a positive trend. Okay, push up, higher high, higher low, higher high, higher low, break, confirmation of an uptrend. Realistically, what we're trying to do as day traders is find key areas early on in the trends to then be able to get in on positions, ride the move up, maybe flip our position, trade back to the downside. And that's going to allow us to contain our risk down here, play to the upside, be able to make, for example, 6 times what we're risking on the trade, close the trade out. And even if we're wrong a bunch of times, we'll still be profitable over an amount of time. So first step is really identifying these trends. So this is really the opportunity zones that I'm talking about. Now, if we go down to a candlestick view, we can actually get a little bit more detailed with exactly what we're looking at. So what I like to do is use my trend tool here, and I'm basically picking out levels where price continually seems to be bouncing off of. So I can click from here, I can drag along this level. I really want to have all of them making contact the best as possible. So if I drag a line down to here, now you'll notice we're having contact points here, and contact point here. Okay, and there's lots of ways to read trends. Okay, for this video, I'm going to keep it pretty simple, but you can see if we're trying to buy in early on a new trend and play to the up direction, what we're really waiting for as our first step is to figure out when price is actually breaking out of this downtrend, potentially creating the beginning of a new uptrend. So by drawing this level, now I can identify exactly where price is leaving this downtrend. And as we get further into the strategy, this is going to become more and more important, but you'll notice as price pushes finally through this level that can't be broken for a long amount of time, price comes back down, tests the opposite side of that, and that's the last point before a massive move to the upside. Okay, so anytime I'm starting a trading session, I'm always starting by drawing out these lines to figure out what trend we're currently in. I can do this on the opposite side too. So if I draw my trend line off of this level, and this level, you'll notice price comes up, finally breaks below that level, makes contact here, and that's the last high that it made before this massive downtrend here. Okay, let's do it one more time. We have this level, this level, this level. So we can go ahead, find our new trend, high level, high level, high level, high level, price breaks it, comes down, tests that level, and continues moving up. So we really want to get good at looking looking at charts, identifying these key opportunity zones, and then seeing when they start to move out of that opportunity zone to go in, put ourselves in good general positions to catch trends early, then start looking at more of the details of the strategy. So step 2, which is that B category, first thing that I'm looking at is finding general areas where markets are either undervalued or overvalued. So you'll notice there's something called an RSI, which stands for Relative Strength Index. So this is going to give us a lower line that is 20 and a higher line, which is 80. You can change this, but that's the standard settings. Okay, when this line graph goes below that 20 level, it can oftentimes indicate that the market is relatively oversold. And conversely, on the other side, when it's above 80, can mean that it's overbought and price has a chance of being able to flip in the opposite direction. This is going to put us in high potential reversal areas to sort of add to that layer of confidence that the trend could be reversing. Okay, so you'll see we get a significant push down. We go into our undervalued territory. Now this happened over here as well, so we can't use this as a one-stop shop indicator. This is something called a confluence. This is something that allows us to use this with other context clues to be able to get in good areas of the market. Okay, but this is going to allow us to read when we could get potential reversals in price. You'll see overvalued here, we get a pullback. Undervalued here, we get a push up. This is just a good thing to always keep an eye on. Right here, undervalued, price pulls up. Okay, you can see this low point, pull down, push up, high area over here, overvalued on the RSI. Okay, so that's step 1 as our confluence. Phase B in our trade criteria is looking at something called market structure. So this, in addition to the trend analysis, is going to allow us to see really where we're seeing these major confirmed changes in the actual trend. It takes a lot of the guesswork away. As we were looking at our trends before, where we have low levels, low levels, low levels, we have another low level put in, price fails to make another high over this area, pulls down. That's something called a change of character. And this is how it looks on a chart. So whenever you have a push, a pullback down on a trend, and then a push above that previous level, that's something called a break of structure. Once again, break of structure, considering this point didn't break over this next level, that's not a break of structure. And then we get price to come back down, indicating that the trend is failing or becoming weaker, breaking under this low. That's considered a change of character. Now this is going to work in both directions. So you'll see with the downtrend, we have a break of structure, fails to make a new low, pushes above, change of character. If we're going long and we want the market to go up, and that's what we're going to be buying into, we want to see a change of character to the upside. If we're going short and we want the market to move down, and that's how we're going to make money, we want to see a change of character to the downside. Okay, so that paired up with these two other things is going to once again add the next layer of confluence. And just so that you can see this sort of change of character concept working in real time, this is the chart that I have. Okay, I like to use Lux Algo smart money concepts, and then I can customize all of these however I like, which will automatically populate them on the chart for me. But if we look, we have undervalued on this swing low period. We have our contact points here, 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 here. And as we play forward, you'll see we have a new level with a bunch of very, very strong candles finally breaking out of this important level. And you'll see right in here, we have a change of character, just like we saw on the diagram. And you'll see that's the last point before a massive move in the opposite direction, confirming that price will change. And now with a little bit more detail that I'll show you in a second, can open up trade opportunities for us. So we're just starting to piece together high opportunity areas. Okay, so the third criteria that I'm really looking at for good opportunities in step 2, after 8 a.m. in the morning, is something called fair value gaps. So a fair value gap is basically when we have 1, 2, 3 candles in either a bullish or a bearish direction, where the first candle's high wick doesn't overlap with the low wick of the third candle, leaving behind this boxed area here. So this is a bullish fair value gap, and the same thing is true. We have 1, 2, 3 candles. Actually, this box should be down here, but ignore that for the diagram. Okay, so we have this wick and then this wick, which leaves us this bearish fair value gap. Okay, and oftentimes what happens with these and how I'm sort of looking at managing and setting up entries is you'll see price will tend to push, come back into the midpoint of this fair value gap, have a response, and then continue moving through it. Now, this level is called in smart money the consequential encroachment line. Basically, what we're looking to see happen is for the candle to have a positive reaction off of the midpoint of this fair value gap. Okay, anytime price is moving on a chart, realistically, price is just trying to find the path of least resistance and will typically flow back into areas of liquidity, fill up that liquidity, and then continue moving in the direction. Now, when it makes a significant push, especially when it's a change into one direction, typically this happens pretty quickly and it can skip through orders, which means there's orders here that are left behind that haven't been filled yet. Price reverts back to that to fill that inefficiency before continuing into the direction that it's going. And this is the general premise of why I'm looking to these areas to be able to enter in to catch very early parts of fresh new trends, allowing my positions to continue moving. Before I start showing you some examples so you can really start to see this happening in real time, the reason that this works is not because we're doing some magic formula where we're predicting predicting something or we have some information that others don't have. That's not how trading works, right? Everyone's using the same information and has the same access to things. Really what we're doing is trying to stay out of no man's land, nonsense land, where people are just entering based off of ideas and it's completely random. So we're cutting out 90% of the BS. The rules are going to put us into high probability areas. And trading is not about being right or being wrong. It's about letting your winners, when you are right, be substantially bigger than your losses and keeping your losses small. That's really what this boils down to. And just following this framework is what I've been using to be able to just let my positions run, keep my losses small, and pick good areas to get into the market. I'm not doing anything magical. Really, this is the fundamental framework of trading that's going to put you ahead of 90% of people that are doing this just by understanding this critical thing. So let's take a look at some replay examples. Okay, and you'll see on my chart here, I have a Lux Algo fair value gap with these settings so that these fair value gaps are automatically getting picked up on the chart based on my threshold, which can change and sort of be fluid, but I'm looking at which ones actually make sense. And then I have my smart money indicator on. That allows us to even further be more selective on the trades to be able to improve our results over time. Okay, our team is absolutely crushing it right now, which is great to see. What I want to share with you here on YouTube is the framework to be able to actually apply this and understanding how this is possible so you can actually get value out of this. Okay, so I do have sell signals here with our proprietary indicators, as well as a few other things that I'm looking at. But let's say we're just looking at the criteria that I was showing you before. All right, so let's take a look at an example here. So in this example, it's 9:30, right? Anything past 8 is really okay is when I'm starting to look for these setups, but 9:30 is where there's going to be a lot of market participation as the New York stock market opens. First thing that I'm doing, finding my opportunity zone, right? So I'm identifying this low, and now we're seeing we have a change of character and a break underneath that level that hasn't happened before. All right, and then you'll see fair value gap produced. You'll see price pulls back into the underside of this trend as well as into the fair value gap. So now we're realistically looking at placing stop loss outside of a critical level right here. What I do is set my target to be determined. Really what I'm looking at is starting for a 1 to 4 target. So I'll make 4 times what I'm risking. See, price gets a response off of that critical level, breaks down low, hits my 1 to 4. Okay, once we get this swing where our entry comes and then we get a push down, this is creating, once again, a break of structure. So that's going to confirm that we don't want price to come back up over this most recent swing. So at this point, this is where I'm looking to reduce my position down to break even. Now it really comes down to how you want to manage your position. So you can either just take it at 1 to 4, or if you want to let trades run a little bit, you can just sort of trend follow off of these lows, price pushes above, and you take profit off here. That way, if price continues to roll down, you can sort of trail it into momentum, all right? But if it reverses, you can sort of lock in profit. Okay, we have a bunch of different models that we've designed that are a little bit more intricate than this, but just to keep it simple for the video, you can sort of just trend follow from there. All right, so let's take a look at another example. So we got price sort of pushing, trending. There was no real pullbacks in here, so no opportunities. Okay, once again, I'm getting overvalued on my RSI, so my ears are perking up. I'm gonna mark out my opportunity zone. So as soon as price is really breaking underneath this level, that's really where I want to start looking for opportunities. Okay, so you can see fair value gap in here, as well as fair value gap in here. So off of my trend, price comes into the underside contact here, right? So I can enter at midpoint, set my stop loss comfortably outside of that area, set my position to 1 to 4. Price breaks below that swing level, so I can reduce my risk down to 0. Okay, and once again, depends on how you want to manage risk, but if we just want to sort of trend follow this down, we can just bring our stop loss down into profit. Now we're already up 6x what we're risking on the trade. All right, so if we're just trend following, we got a break of structure, which means we don't want this level to really be violated. So stop loss could really come down to here, but I'm probably going to walk it down, something like that. Continue walking it down. Now we're up 7R. Price comes up and gets us out for like 7.7R. So if we're to look at this, say you're risking $50 on the trade, 50 times 7.74, you're making $387, risking $50 by being able to identify and sort of pick out these points. So if you just get one of those trades, you can then be wrong like 5-6 times in a row and you'll still be up like $100 on a session. That's really how trading works, and that's how I operate. So if I'm risking 500, you know, multiplied by that 7.74, now I'm making $3,800 risking $500, and I can lose 500 after that, 500 after that being wrong, 500 after that being wrong, 500 after that being wrong, and you get the point. I can be wrong a lot and still have a really, really nice buffer to then be able to say make $2,300. And that's how I'm able to sort of rack up these daily gains just by being fairly selective and getting into these good areas. Okay, and these opportunities happen a ton. Okay, so now that you understand how it works, let's take a look at some live examples of me actually doing this, because in concept, in bar replay, it's a lot easier. I want to show you in real time my executions and my decisions. Okay, and this is why I really put this openly on YouTube, because there's struggles when you're doing this in reality that I want to share with you guys. So you can basically like learn from this, but then also also be able to watch actual implementation and see how it works and looks in reality. All right, so let's take a look at our first example. So what I've done, I've first drawn and understood my opportunity zone, waited for a critical move down with a fair value gap, and we have our change of character. Okay, you can see price came back up, tapped into that perfect area, got me filled beautifully, started pushing down in our direction. Something important to note, bar replay is going to be a lot less emotional, but when you're watching a profit come in, like for example, I'm up like $1,200, $1,100 on this trade. If price comes back up and touches your entry and erases all of those moves, it seems like you've sort of wasted your own time or let go of money that you could have locked in. But this is the critical dilemma to understand in trading. That new push down is progress made in a bearish direction, and you're required to be able to sit through this oftentimes to be able to let these big gains actually come to fruition. Okay, so I was just sitting in this. We got another response off of that level. Price finally breaks down, breaks that level. Now I'm up even more, right? By being patient, by allowing this trend to sort of play out. Now I can start looking to reduce risk. Okay, we get a nice push really quickly through my 1 to 4. I'm up like $2,600 now. Okay, and I go ahead and close that position out for about 5.5 risk factors. So now I've locked in over 5 times however much I was risking, once again, just by finding that really critical area. Okay, let's take a look at another example. So once again, I mark off my opportunity zone. Now I'm building out my position. I'm setting my entry at the midpoint of that fair value gap. All right, so I have my entry quantity and my stop loss set up. Price gets a really nice response off of that area after we broke out of that new trend. I set up my 1 to 4, and now I'm basically just trailing this, seeing which area we could potentially run into resistance. You can see I'm up about $4,000 on that trade, and we're up about $4,500. Start to get a bearish response, and at about $5,000 in profit, so 10x what I was risking. I closed this trade out beautifully right as it's running into this critical level, and you'll see that ended up being the right decision. Price starts moving down after that point. Take a look at another example. Opportunity zone, undervalued on our RSI, high impact candle right here. Price dips back into it. I enter on my midpoint. Takes a few moments to chug along. I set my take profit at this area where we got support and then resistance, up about $2,200, and my take profit is snagged. Once again, this isn't a crazy gain, but 4 to 5x what I'm risking is really what we're interested in, so that we can be wrong a ton, but as long as we're following this process, we know that over time we'll be able to make money. Okay, because there are going to be situations, for example, we have a really good setup, opportunity zone, fair value gap, good push, good contact, really nice momentum. All right, up about 1,000 at this point, comes back down, contacts that point. So technically our idea was right. Something to understand about technical trading, we're looking to get good responses off of technicals and then allow the fundamentals, allow the market to play out. If it's going to play out in our direction, we've entered at a good spot. We can still get good technical responses and have the market end up failing on us. We can't control that, but we can control getting in good areas and letting the market play out. Okay, so you'll see I was really letting this position sort of run. I couldn't really reduce risk yet. Price comes down and ends up stopping me out for right around $500 as my contained risk, right? So I don't need to be right every time. You're not going to be right every time. Anyone who's in this game telling you that you need to be right and you need to predict markets, they don't know what they're talking about, or they're trying to deceive you. And this is the framework that we're drilling in on the private side of our team. You can see Felix nailing NQ trade for $1,200 gain, 7.5R for Dimitri, still learning. Mav 7xing his account, 10R on Smog. Hero on the private side of our team, 16R on ETH, risking $30, making $480. So that's really what we're focused on, but I wanted to share with you guys this framework that's been really helpful for me. If you want to dive more into trading, you can check these videos out. Make sure you like this video and subscribe if you want to know when I drop new content in the future. Take advantage of our free resources, and until next time, I'll see you all in the next video.